They are simply crashing silver on purpose. I am going to show you the exact reasons why they are doing this, who benefits, and what happens next. Because what you are seeing right now is not a normal correction. This is coordinated, this is strategic. If you do not understand the mechanics behind what just happened, you will miss one of the greatest setups in the silver market we have seen in years. Today is Wednesday, the 4th of February, 2026. Silver is trading at $83.79. But let me tell you what just happened. Thursday, the 29th of January, silver opened at $114.58, then rallied to $121.57, then closed at $113. Then Friday was $83. The 30th of January, silver opened at $113.91, spiked to $118.59, then completely collapsed. The low of the day reached $76.67. The closing price was $86.33, down $42 from Thursday's intraday high to Friday's intraday low, plunging 35% in 2 trading sessions. What they are not telling you is, silver did not just fall, it was fallen. The people who orchestrated this move are not trying to exit the market. They are trying to get in before the real breakout begins. Let me show you the evidence. The 26th of January, COMEX reported a massive single-day withdrawal of physical silver from registered vaults. Over 3 million ounces withdrawn in one day. This is not profit taking, this is panic buying disguised as a vault transfer. Because when prices fall and physical silver disappears at the same time, it tells you one thing: the paper market and the physical market are no longer in sync. Someone is using paper contracts to drive the price down, while simultaneously accumulating the metal. This divergence is about to create the most violent short squeeze we have ever seen. This is why this matters. Now, COMEX silver inventories have been declining. For 9 consecutive months, we are at the lowest registered silver levels since 2016. This is a decade-long decline. During the same period, industrial demand for silver has exploded. Photovoltaic solar panel production alone consumed over 161 million ounces of silver. In 2025, this number is expected to reach 210 million ounces this year, and it is not slowing down. Every solar panel requires approximately 20 grams of silver. There are no substitutes and no alternative materials that match silver's conductivity and efficiency at scale. So when you see prices falling as physical inventories vanish, you are not looking at a bear market. You are looking at the preparatory stage of a supply crisis. Now let me tell you who is behind this and why they need the price. The largest accumulators of physical silver right now are sovereign wealth funds and central banks in Asia, particularly institutions in China, India, and the Middle East. They have been converting dollar reserves into hard assets. Silver is the most undervalued hard asset on Earth relative to its industrial utility. The gold to silver ratio is trading at 56-1. Historically, this ratio was closer to 15-1 in normal market conditions. But when financial stress accelerates, this ratio compressed during the 2011 silver rally, dropping to 32-1. During the March 2020 crash, it spiked to 125-1, then reversed violently. What we are seeing now is deliberate price suppression, preceding a major accumulation phase. The entities crashing the paper price are not retail traders. They are institutions with multi-billion-dollar balance sheets. They need to buy physical metal at the lowest possible entry point before the breakout occurs. They are using the COMEX futures market to create the exact conditions they need. Here is how the mechanism works. A large institution sells thousands of silver futures contracts during low liquidity hours. Usually this happens during the Asian session or right before the New York market opens. The goal is not to profit from a short position. The goal is to trigger stop-loss orders and algorithmic selling from momentum traders. Once the cascade begins, the price drops rapidly. Retail investors panic, and margin calls force liquidations. While everyone is selling paper contracts, the same institution buys physical metal in the spot market at artificially suppressed prices. This is not a theory. This is documented behavior. In 2020, JP Morgan was fined over $900 million for using this exact strategy to spoof precious metals markets. They placed massive sell orders to move the price, then canceled those orders before execution. While buying physical metal, the fine was the largest in CFTC history. But this strategy did not stop, it just became more sophisticated. Now here is the critical part for you. The amount of silver available for physical delivery on COMEX is falling faster than at any time in the last decade. Registered silver is the only category eligible for delivery against futures contracts. It currently stands at just over 77 million ounces. It sounds like a lot, until you realize that the open interest in COMEX silver futures represents over 890 million ounces of paper claims. That is a leverage ratio of 11-1 for every ounce of physical silver in the vault. There are 11 paper contracts claiming ownership. Here is the problem. If 10% of contract holders demand physical delivery, the system collapses, and the exchange cannot deliver. The price discovery mechanism breaks down. The spot price completely decouples from the futures price. This is the trap they are setting right now. Let me tell you what is happening in the physical market. While paper prices are suppressed, premiums on physical silver coins and bars have been steadily rising since mid-January. American Silver Eagles are trading $6 to $8 above spot. In some markets, that is a 12 to 15% premium. Canadian Maple Leafs have similar spreads. Even generic silver rounds, which usually trade $1 to $2 above spot, are now showing premiums of $4 to $5. Premium spreads have increased by 400%. In less than 3 weeks, this is not normal market behavior. When premiums rise while the spot price falls, it means one thing. Physical buyers do not believe the paper price. They are willing to pay far above the synthetic quote, because they understand that physical silver is undervalued. Supply is tight. When this divergence grows large enough, the paper market loses all credibility. At that point, price discovery shifts entirely to the physical market. When that happens, the repricing is not gradual. It is instantaneous and violent. Now let me tell you what the banks are doing. While all this is happening, the 4 largest bullion banks hold a combined net short position of over 150 million ounces of silver on the COMEX. That is double their average short position. Over the last 5 years, they are not hedging mining production. Most silver miners do not hedge. 70% of global silver production is a byproduct of copper, lead, and zinc mining. These operations do not hedge silver risk because it is not their primary source of revenue. So if banks are not hedging production, what are they doing? They are suppressing the price to cover previous short positions and accumulate physical metal before a system reset. This is the playbook they ran in the 1970s. In 2011 and in 2008, the pattern is identical every time. Suppress the paper price, accumulate the physical metal, let the system break, then profit from the repricing event on the long side. This is the part that should terrify every retail investor. They do not understand what is coming next. When the short squeeze begins, it will not be a slow rise. It will be a gap event. Silver will open $10, $15, or $20 higher overnight. Futures markets will halt trading. The spot price will completely decouple from COMEX. Retail investors who are waiting for confirmation will be priced out before they can act, because by the time the move is visible on CNBC, the entry point is gone. This is not speculation. This is pattern recognition, based on every silver squeeze in modern history. Let me walk you through what happened in 2011. Silver started the year at $29. By the end of April, it had reached $49. That is a 70% move in 16 weeks. But that move did not happen gradually. It happened in 3 explosive bursts. Each burst was triggered by a failure to deliver event, or a vault drawdown that caused panic among short holders. The final move from $42 to $49 happened within 9 trading sessions. Once it hit the peak, the crash was equally violent. Silver fell from $49 to $32 in 5 days. But here is what most people missed. Investors who understood the context were not trying to catch the top. They accumulated physical metal in the 20s and held through the volatility. When silver finally stabilized in the mid-30s, they were still sitting on 50% gains. The same pattern is forming now, except this time, the fundamental indicators are much more bullish. Industrial demand in 2011 was a fraction of what it is today. Solar was not a major factor. Electric vehicles were not mainstream. 5G infrastructure did not exist. Silver was primarily a monetary metal. Today, it is the most critical industrial commodity. In the global energy transition, supply cannot keep up. Here are the numbers you need to know. Global silver mine production in 2025 was approximately 822 million ounces. Total demand, including industrial, investment, and jewelry, exceeded 1.05 billion ounces. That is a 230 million ounce deficit, and that deficit is being filled by above-ground stocks. Scrap recycling and the COMEX vault drawdown, but those sources are finite. Scrap recycling cannot grow fast enough to meet industrial demand. Above-ground inventories are being depleted. COMEX vaults are at critical levels. So what happens when the deficit can no longer be covered by secondary supply? The price must rise until demand is destroyed, or new supply is incentivized. But the problem is, industrial demand for silver is inelastic. You cannot make a solar panel without silver. You cannot make an electric vehicle without silver. These are not discretionary purchases. They are required inputs for infrastructure. Governments around the world have already committed trillions of dollars to deployment. That means the only variable that can adjust is the price. The adjustment will not be gradual. It will be exponential. Let me show you what is happening at the geopolitical level. Most analysts completely ignore this. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with new members like Saudi Arabia, the UAE, and Egypt, are actively working to build a commodity-backed trade settlement system that bypasses the US dollar. Silver is one of the core commodities being discussed for inclusion in this system. The reason? Because silver is universally recognized, a highly liquid industrial necessity that cannot be printed. Even if just a small fraction of global trade starts settling in commodity-backed instruments, instead of dollars, the demand for physical silver would explode overnight. We are not talking about a 10% or 20% increase. We are talking about a structural shift that could absorb hundreds of millions of ounces annually, and the current supply chain cannot support that. This is why central banks and sovereign wealth funds are accumulating silver now. They are positioning themselves before the monetary reset. Most retail investors do not even know it is coming. This is the final piece of the puzzle. The US government has no strategic silver reserve. The national defense stockpile used to hold over 139 million ounces of silver. It was completely liquidated in 2005. Today's inventory is 0 ounces. Meanwhile, the Department of Defense has listed silver as a critical mineral. Essential to national security, missile radar systems, satellites, and advanced electronics all require silver. The US has no domestic buffer. So what happens if a geopolitical event disrupts the silver supply chain? If China controls a large portion of global silver refining capacity and restricts exports? Or what happens if industrial demand continues to spike while mine production remains stagnant? The answer is simple: a price spike to levels where demand is destroyed, or emergency supply is mobilized. Given that industrial demand is inelastic and strategic reserves do not exist, the only remaining mechanism is price. But there is something even more dangerous happening beneath the surface, connecting all these dots. This is why this crash was orchestrated when it was. Look at what is happening in the broader commodity sector right now. Copper is breaking multi-year highs. Lithium is stabilizing after a brutal correction. Nickel is showing signs of supply stress. Rare earth elements are facing geopolitical pressure on the supply chain. These are all inputs for the same industrial revolution that is driving silver demand. Yet silver is the metal with the worst supply deficit and the most widespread industrial utility, and it is being crushed. This is not happening by accident when all other critical commodities are rising or stabilizing. The commodity with the worst fundamentals is falling. You are seeing deliberate intervention not from retail traders or even large speculators, but from entities that need to acquire a massive position before the system reprices. Here is what they know that most investors do not. The global energy transition is not optional. It is mandated by law in most developed economies. The EU is committed to carbon neutrality by 2050. The US is committed to a 50% reduction in emissions. By 2030, China is committed to peaking emissions by 2030 and carbon neutrality by 2060. These are not ambitious goals. These are legal frameworks with enforcement mechanisms. Every one of these goals requires multiples of the silver currently being produced. Let me give you the numbers. A utility scale solar farm requires approximately 350 metric tons of silver, over 11 million ounces. The International Energy Agency expects solar capacity will need to triple by 2030 to meet global climate goals. That means an additional 600 gigawatts of solar capacity every year. Every gigawatt requires about 30 metric tons of silver. Do the math, that is 18,000 metric tons of silver annually. Just for new solar installations, over 578 million ounces per year. Now add electric vehicles. An electric vehicle contains about an ounce of silver, used for electrical contacts, circuit boards, and charging infrastructure. In 2025, global EV sales were approximately 14 million units. This number is expected to reach 40 million units. By 2030, that means an increase in demand of 26 million ounces per year, just from the growth in EV production. Now add 5G infrastructure. Every 5G base station requires approximately 3 times the silver of a 4G base station, due to higher frequency requirements and more complex circuitry. There are currently over 5 million 5G base stations worldwide. This number is expected to exceed 15 million by 2030. That is additional millions of ounces in demand annually. Now add artificial intelligence and data centers. AI chips require more silver than traditional processors, due to higher power densities and thermal management requirements. The AI boom is driving unprecedented demand for high-performance computing infrastructure. Every chip, every server, every cooling system requires silver. When you add all of this up, you get a structural demand surge that is mathematically impossible to meet at current production levels. This is the key insight. This demand is not price sensitive in the short term. Governments have already committed the funds. Infrastructure projects have already secured financing. Supply chains are already locked in. The silver must be acquired regardless of the price. The only question is when the repricing happens. And the entities orchestrating this crash know the repricing is coming. They are just trying to accumulate as much physical metal as possible before it happens. Let me show you what is happening on the supply side, which makes this situation even more critical. Primary silver mine production, meaning silver extracted specifically for silver, and not as a byproduct, has been declining for over a decade. Most new silver supply comes from multi-metal mines, where silver is a secondary product. When base metal prices fall, those mines cut production. When they cut production, silver supply contracts even if the silver price rises. This creates a supply-response paradox. In normal commodity markets, price increases incentivize new production, but for silver, price increases alone cannot incentivize new primary production, because the economics of pure silver mining are marginal at best. Most silver ore grades are too low to justify independent development. They only become viable when developed alongside copper, lead, and zinc, or gold. That means silver supply is structurally constrained by the economics of other metals. And right now, base metal production is facing its own set of challenges. Environmental regulations, make new mine development more expensive. Permitting timelines have extended from 5 years to over 10 years in most jurisdictions. Capital costs for new projects have doubled in the last decade. Ore grades are declining across the board. The result is that the supply side cannot react to demand growth in any meaningful time frame. Even if silver doubles or triples in price, new production will not come online for years. Meanwhile, demand continues to accelerate. This is the supply-demand mismatch. The institutions accumulating silver now understand this perfectly, but there is another layer. Most analysts completely overlook it, and it has to do with the changing structure of the silver market itself. For decades, the silver market was dominated by investment demand. Silver was primarily a store of value, a hedge against inflation. A monetary metal, industrial demand existed, but the driver was completely reversed. Industrial demand now represents over 60% of total silver demand, and that percentage is growing every year. Why does this matter? Because industrial demand behaves fundamentally differently than investment demand. Investment demand is discretionary and price sensitive. When silver becomes expensive, investors can choose to buy less or wait for a correction. But industrial demand is non-discretionary and price insensitive. In the short term, if you are building solar panels, you cannot substitute another material for silver. If you are manufacturing electric vehicles, you cannot eliminate silver from the design. Without it, the product simply does not work. The shift from investment-led to industrial-led demand fundamentally changes the price discovery mechanism. In an investment-led market, price suppression works because investors can be spooked out of their positions. But in an industrial-led market, price suppression creates a supply crisis because industrial users cannot reduce consumption. This is exactly what is happening right now. The paper market is being used to drive down the price, but industrial buyers are not buying less. They are continuing to acquire physical metal at artificially low prices, while institutions orchestrate the suppression, accumulating right alongside them. When the physical supply is exhausted, it will render the paper price irrelevant. Physical buyers will pay whatever price is needed to secure supply. At that point, the decoupling of paper and physical prices becomes so extreme that it discredits the entire futures market. We saw this dynamic in nickel in March 2022. The London Metal Exchange had to halt nickel trading and cancel billions of dollars in trades because physical supply vanished, while paper contracts continued to trade. The LME price and the physical price decoupled by over 100% in a matter of hours. When trading resumed, the entire market structure had changed. Silver is heading toward the same tipping point. The only question is when. Now let me tell you what the smart money is doing while all this unfolds. Sovereign wealth funds and central banks have been net buyers of physical silver. For 18 consecutive months, they are not buying silver ETFs. They are not buying mining stocks. They are buying physical bars and taking delivery into allocated storage. This is the same accumulation pattern we saw in gold. From 2010 to 2012, before gold went from $1,200 to $1,900. But silver is accumulating much faster, because the available supply is much smaller. The entire global silver market is worth approximately $85 billion at current prices. That is less than the market cap of a single large tech company. A sovereign wealth fund, managing $500 billion in assets, could buy 5% of the global silver market with just $25 billion. That is a rounding error for some of these institutions, and they are doing it not publicly and not through ETFs, but through private transactions, vault transfers, and OTC deals that never appear on exchange data. The evidence is in the vault movements. COMEX registered silver is down over 30% in the last 9 months. LBMA silver holdings are down over 15%. Meanwhile, allocated silver vaults in Singapore, Hong Kong, and Dubai have grown by over 20%. The metal is moving from Western vaults to Eastern vaults, from exchange, traded inventory to privately held allocations, from paper claims to physical possession. This is not a bear market. This is a wealth transfer, and it is happening while retail investors are being shaken out by price volatility. Here is the timeline you need to understand. The entities accumulating silver right now are not trying to time a short-term trade. They are preparing for a multi-year structural repricing. They understand that the supply-demand imbalance is not temporary. It is a permanent feature of the new industrial landscape. They are buying physical metal at prices that will look ridiculously cheap in 2 to 3 years. But they need time to accumulate. They need prices to stay suppressed, long enough to build their positions. This is why the crash is happening now. This is why it is happening on low volume during a period when most institutional traders are focused on other markets. This is why it might last for a few more weeks or months until the accumulation phase is complete. But here's the key insight. The accumulation phase will not last forever. At some point, the institutions that have been suppressed prices will flip to the long side. When that happens, the move will be violent and unstoppable. How do you know when this shift is coming? You watch the physical market, when premiums start spiking above 10%, when delivery delays extend beyond normal timeframes, when major dealers start limiting purchases or increasing minimum order sizes. These are the signals. Physical supply has become very tight. When physical supply becomes tight enough, the paper market breaks. We are not there yet, but we are getting close. This is what you need to do. Right now, if you do not have physical silver, this pullback is your entry point, not because the price cannot go lower. The institutions orchestrating this move absolutely can. They have the capital to push the price down another $5 to $10 if they need more time for accumulation. But the risk-reward ratio at $83 is asymmetric, skewed to the upside. If you are wrong and silver falls to $70, you lose 15%. If you are right and silver reprices to $150, in the next 18 to 24 months, you gain 80%. If a real supply crisis emerges and silver breaks $200, your position doubles or triples. But here is the critical part. You must own physical metal, not an ETF and not a mining stock, not a futures contract. It is physical silver that you possess, or allocated storage that you control, because when the paper market breaks, it will break. ETF shares may not be redeemable for physical metal. Mining stocks will be subject to political risk, operational risk, and stock market volatility. Futures contracts will be settled in cash, at a price that has nothing to do with physical reality. The only thing of value in a supply crisis is the physical metal itself. The only way to guarantee you own that metal is to take delivery and store it securely. Here is the practical framework, starting with sovereign coins. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. These have the highest liquidity and recognition worldwide. They trade at a higher premium than generic rounds or bars. But for security and resale flexibility, that premium is worth it. If you are buying in larger quantities, consider bars from recognized refiners like PAMP, Valcambi, the Royal Canadian Mint, or Perth Mint. These bars have lower premiums than coins, but secondary market demand remains strong. Avoid collectible or numismatic silver, unless you are an expert in that market. The premiums are too high, and the resale market is too narrow. Store your metal securely. If you store at home, use a high-quality safe bolted to the structure of the house. If you hold significant amounts, consider allocated vault storage through a reputable provider. Allocated means the metal belongs to you, and is segregated from the storage provider's assets. This is critical for legal protection. Do not use unallocated storage. Unallocated means you have a claim on metal pooled with other customers' metal. In a crisis, unallocated claims may not be honored. Most importantly, do not over-leverage. This is not a trade you want to be forced out of due to a margin call or liquidity stress. Institutions are crashing the price right now. They hope leveraged buyers will panic and sell. Do not give them that chance. Buy what you can afford for a 2 to 3 year time frame, because that is the time frame in which repricing is likely to occur. The entities crashing the price right now are not trying to destroy the silver market. They are trying to accumulate before the breakout. They are using your fear and confusion to buy at the lowest possible price. Do not give them that opportunity. This is the setup where inventories are being depleted. Premiums are rising, and the fundamental drivers are undeniable. Industrial demand is accelerating, supply is constrained, and sovereign buyers are accumulating. The people who understand the context are buying, while everyone else is panicking. The question is not whether silver will go higher. The question is whether you will be prepared before it does.